Hi, I'm Mike Turner. I've developed a set of rules that I call my 10 essential rules for beating the market. Rule number 8 is the diversification rule. This is a simple but very important rule for minimizing the risk that you have with your investments. You know, you can do everything right. You can go through the process of picking the right stock at the right time, putting your stop losses in. You can look at the institutional ownership. You can do all of these things, and if you're not diversified, you can still lose a lot of money. Here's what happens, and many investors fall into this trap. When the economy or the market begins to change, and all of a sudden there is a group of stocks that begin to really move up, you will not have one or two of them. You might have 30 or 40 of them. And maybe it's basic materials, just to pick an example of a sector. And there are literally hundreds and hundreds of stocks in the basic materials sector. And they could all begin moving up. Great stocks, great fundamentals, great technicals. Everything looks great. And you can find yourself buying XYZ company because of all the right reasons. And then you start looking at ABC company. And by golly, it looks almost as good as XYZ, if not better. So you buy it. And the next time you buy another one. And if you're not careful, you end up with an overloaded portfolio of stocks that are all in one sector. Well, here's the problem with that. You're making good money. That's good, and that's working great in your favor while they're moving up. But when that sector changes, and it can change in a heartbeat, you could well be in a position where that the price of those shares will turn almost en masse and begin moving down. You can lose a lot of money by having too many stocks all in one sector. So I've got a rule about that, not to be overloaded from a diversification standpoint. And here are the rules. All stocks are grouped by sector and industry. And so kind of part A of this rule is that don't ever put more than 30% of your total portfolio in any one sector. Part B is don't put more than 20% in any one industry. Now, what this will do, it will force you to make decisions about where you might want to, or what you might want to buy. Because what will happen as you go through the process of narrowing down the list that you want to consider buying, you'll find a stock that really looks attractive to you, but it is in the same sector or industry that you already own several other positions in. And if you bought it, if you do the math on it, you'll find that you've moved over that 30% or you've moved over that 20% depending on the sector or the industry. And you don't want to do that. So you're going to have to make a decision. Do you sell one that's already in an existing sector? And maybe that move, that you can bring that new stock in and take its place. That's okay to do that. But if you'll stay at at those two rules, no more than 30% in any one sector, no more than 20% in any one industry, it will force you to be diversified. Instead of trying to figure it out or watch various shows on TV that help you determine whether or not you're diversified or not. This is a simple rule to go by. Every stock is tagged as to whether or not, or is grouped by what sector it's in and what industry it's in. It's very easy for you to do the math to add up how much of your portfolio is dedicated to each one of those groupings, sector and industry. Stay within that 30% and 20%, and you'll be diversified.